The history and role of the Federal Reserve and central banks. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. Its establishment in 1913 marked a pivotal moment in the nation's economic history, addressing the need for a more stable and flexible financial system. To understand the importance of the Federal Reserve and central banks in general, it is essential to explore their origins, functions, and the critical role they play in modern economies. Now, before we move on with the story, please help a small channel grow. Like and subscribe. It means a lot to me. Okay, back to the story. The origins of the Federal Reserve. The history of the Federal Reserve begins in the early 20th century, a time when the U.S. financial system was plagued by instability. The 19th and early 20th centuries were marked by frequent financial panics, bank runs, and economic recessions. The Panic of 1907, in particular, highlighted the fragility of the banking system. During this crisis, banks faced massive withdrawals, and the lack of a central authority to provide liquidity exacerbated the situation. It was only through the intervention of private financiers like J.P. Morgan that the crisis was temporarily resolved. Recognizing the need for a more permanent solution, Congress established the Federal Reserve System with the passage of the Federal Reserve Act in 1913. The Fed was designed to serve as a lender of last resort, provide a stable currency, and regulate the banking system. Its structure was unique, consisting of a central governing board in Washington, D.C., and 12 regional Federal Reserve banks distributed across the country. This decentralized structure was intended to balance the interests of different regions and prevent the concentration of power in a single entity. The role of central banks, like the Federal Reserve, exist to manage a nation's monetary policy, regulate financial institutions, and maintain economic stability. Their roles can be broadly categorized into three key areas: monetary policy. Central banks control the money supply and interest rates to achieve macroeconomic objectives such as controlling inflation, managing employment levels, and ensuring economic growth. For example, during periods of economic downturn, central banks may lower interest rates to encourage borrowing and spending, thereby stimulating the economy. Conversely, during periods of high inflation, they may raise interest rates to curb excessive spending and stabilize prices. Financial stability. Central banks act as a lender of last resort to banks and other financial institutions during times of crisis. By providing liquidity, they prevent bank runs and maintain confidence in the financial system. The Federal Reserve played a crucial role during the 2008 financial crisis by injecting liquidity into the market and implementing emergency lending programs. Regulation and supervision. Central banks oversee the banking system to ensure its safety and soundness. They set reserve requirements, conduct stress tests, and monitor financial institutions to prevent excessive risk-taking and protect consumers. Why states have central banks? The existence of central banks is not unique to the United States. Nearly every country has a central bank or a similar institution. The primary reason for their establishment is to provide a stable financial environment that fosters economic growth and protects against systemic risks. Central banks serve as the backbone of a nation's financial system, ensuring that it operates smoothly and efficiently. Historically, the need for central banks became evident as economies grew more complex. In the absence of a central authority, financial systems were prone to instability, with frequent bank failures and economic crises. Central banks emerged as a solution to these problems, offering a mechanism to regulate the money supply, stabilize currencies, and provide a safety net during financial distress. The importance of central banks. The role of central banks cannot be overstated. They are instrumental in maintaining economic stability and fostering confidence in the financial system. For instance, the Federal Reserve's actions during the Great Depression, the stagflation of the 1970s, and the 2008 financial crisis demonstrate its ability to adapt to changing economic conditions and mitigate the impact of crises. Central banks also play a critical role in shaping long-term economic outcomes. By managing inflation, they preserve the purchasing power of a nation's currency, which is essential for sustainable growth. Additionally, their regulatory functions help prevent excessive risk-taking and ensure the integrity of the financial system. However, central banks are not without criticism. Some argue that their policies, particularly quantitative easing and low interest rates, can lead to asset bubbles and income inequality. Others question the transparency and accountability of these institutions, given their significant influence over the economy. Conclusion: the Federal Reserve and central banks around the world are vital institutions that have evolved to address the challenges of modern economies. Their history is rooted in the need for financial stability and economic resilience. By managing monetary policy, ensuring financial stability, and regulating the banking system, central banks play a crucial role in promoting economic growth and protecting against systemic risks. While they are not immune to criticism, their importance in maintaining a stable and prosperous economy is undeniable. As the global financial landscape continues to evolve, the role of central banks will remain central to the health and stability of nations worldwide. Thank you for watching my video. Please like and subscribe.